I want to bring in Fred Cannon now. He is Director of Research at KBW, that's Keefe, Bruyette Woods. KBW is one of the go-to research places for the banking industry. And Fred, we're very happy to have you here. I want to ask you right off the bat, PNC, one of the big banks that reported early this morning, loss provisions, charge-offs, both down about 50% year over year. How comfortable are you right now with the credit trends?
Comfortable with the credit trends. I think that's what, in general, the market's been feeling for a while. And some of the stronger banks, I think that's fine. What we're really concerned about these banks, though, is the ability to earn money going forward. And that's been the focus this quarter, looking at the net interest margin. If you look at Comerica today, for example, pretty good numbers, except for that net interest margin. And that stock got hit pretty hard today.
Hey, you know, that's a great point. Net interest margin, in other words, what the banks make, is actually being hurt by Operation Twist, right, where the Fed is going out and buying 10-years. It compresses the 2-year, 10-year spread. Why is the Fed hurting the banks right now when I thought the Fed was supposed to help the banks?
The Fed's trying to help the economy, but in that process, it is hurting the banks. Getting the long end of the curve down and keeping interest rates low for a long period of time is definitely the worst interest rate environment that banks could face. And you're seeing some of that pain being felt in some of the bank earnings reports this quarter.
Now, Fred, do you think it's actually going to get worse for the banks, the net interest margins?
We think the earnings pressure on the banks is going to be around for quite some time. In fact, as we look across, and I think that's what's made some of the investors nervous on some of the highest quality banks this quarter. You look at Wells Fargo, a company a lot of investors had flocked to as the strongest of the big banks, yet they beat their earnings number, net interest margin came down, and the stock got hit.
Yeah, very true. All right, loan growth. I want to talk about loan growth. If you are a loan officer at a bank, I'm wondering how you grow your business. If you look at loan growth, it's still down about 19.6, I think is the exact number, 19.6% versus the 2008 high. It's starting to move up, but again, it's still off almost 20%. So if you're a loan officer, how do you grow your banking business?
Well, there's two types of loans right now, and we're seeing one set start to grow, and that's commercial and industrial loans. And a little bit of business loans are starting to expand. In that area, loan officers are fighting over themselves to get those loans that are starting to grow. On the other side, the consumer side, we still see shrinkage, and that's a big problem for the banks over an extended period of time.
Now, how much more shrinkage could you see at some of these big regionals like a PNC, a Comerica, et cetera?
Well, we think we're starting to get to the point where that growth in business loans can start to offset the shrinkage in the consumer portfolios, but we're probably still 2 or 3 quarters away. So overall, we could see a couple more percentage decline in some of these loan balances, at least over the next 2 or 3 quarters.
Now, one of the things your firm is very good at doing is crunching all the numbers and then coming out and saying, here are the ones you buy, here are the ones you sell. So give us a couple of buys.
Well, we think it's still the quality trade will be on after the quarter. Interestingly, coming into this quarter, Adam, what we saw was, the quality names had definitely outperformed some of the names like Bank of America that weren't seen as quality. That reversed itself with these quarterly reports. We still think that's the trade to make. So we still point investors towards companies like USB, towards companies like SunTrust. We think those are the go-to names right now in the big regional space.
And 30 seconds before we go to break, and we are going to keep you after the break because there's a lot to talk about. Any companies or any stocks that you would short?
Well, we think right now if these weaker banks continue to rally, such as a Bank of America, we think that it might be time to put that short back on, because if you look at those names, some of those lower quality names, Bank of America's, it's not an apocalypse. They're not going to need to raise capital, but their ability to earn money, we took our earnings estimate down significantly on that one.
So what exactly does the crisis in the Eurozone mean, not only for European banks, but of course for U.S. banks? Still with us is Fred Cannon, Director of Research at Keefe, Bruyette Woods. Fred, great to have you back. Let's talk about what the Euro crisis does mean for U.S. banks. Is it quantifiable at this stage?
Well, it's really not. And the reason is that one risk you heard James Gorman before talk about is while the direct exposures are minimal, some of the indirect exposures and the trading between these big banks is significant. For example, the net derivative exposure between the U.S. banks and the European banks is pretty modest. When you look at the gross exposure, it gets to be some pretty big and scary numbers.
They are pretty big and scary, and they're probably dependent also on some sort of probability that there is a recapitalization of the banks throughout Europe. Now, a headline just crossed, which may explain why we've seen a sudden acceleration and a sell-off today from the FT, saying that the European bank recapitalization program may be less than 100 billion euro, which is about half the amount that the IMF estimated would be needed for European banks. Given that news, what does that mean for U.S. banks?
Well, that's not great news for U.S. banks because really what would be great for the U.S. banks is the fullest possible recapitalization of the European banks. That means that counterparty risk we just talked about goes away and we become delinked. Right now, as you know, if you put up a chart of European banks and U.S. banks, there's like a 95% correlation.
Right.
So that would be the best news.
Fred, we have a chart of that at the moment. Does that mean that U.S. banks, or does that mean that you'd be selling European banks at the moment, right? Because they're only down about 4% more than the KBW Bank Index of U.S.
Well, we think that's actually a trade that does make some sense because ultimately, if you can be patient with it, those numbers will delink. And to the extent that the Europeans dilute their shareholders and we don't because we are better capitalized, over time that spread's going to widen and that should be a pretty good trade. But you might have to be patient with it.
Fred, what kind of recapitalization program would ease investors' concerns at this point? If it's not 100 billion euro, is it 200 billion euro?
Well, the hard numbers. The exact right number is hard to say. Really, at the end of the day, recapitalization is about confidence and what restores the confidence in those banks. So that's the most critical component. I think the IMF, with its credibility, puts out a big number like that. It's going to be hard to get confidence back unless they can hit something like that.
You know, Fred, I got to ask you, I read a report, I think it came out of Credit Suisse, one of your competitors last week, where bottom line, it said that 66 of the EU banks would actually be insolvent if you had to use a 9% capital ratio. That's only up 1 percentage point from the current 8% level. Do you agree with that kind of number?
That sounds a bit harsh. I think we would be significantly below that. So I think there's two questions: that how soon does any bank need to get to that 9%, and also depending on the haircuts you put on. But if you just read through some of these CDS numbers into what the amount of haircuts you need on some of this debt, you can get to some pretty scary numbers.
And is it still too early, from your point of view, to buy any of these European banks? Are there any that you would buy, or do you stay away?
Well, we think there's selectively. I mean, if you look up at the Nordics, I think sometimes everything gets washed out with this. We'd be very cautious on the French banks still, but I think selectively, say some of these Nordic banks, I think it can be a safe haven.
Fred, the credit markets have been very active when it comes to banks these days. In fact, we had the CFO of Goldman actually commenting on his own credit default swap, saying that he was actually confused, but he didn't think they were wrong. Do you watch credit trends as a way to, as a gauge, perhaps, as to what the market really thinks about banks?
I think they are, but you have to be careful with the signal. For example, on some of the big banks in the U.S., the credit default swaps are trading at the same level they were going into the crisis. But it's a very different situation today. We do not think that is an indication that the failure of these banks is as great as it was then. However, it's important to factor in Dodd-Frank because Dodd-Frank says that if one of these banks does falter, the bond owners are going to have to take hits. That's a very different perception than going in 2008 when these were viewed as too big to fail.
And then in terms of regulatory overhang, you're talking about Dodd-Frank here. A lot of news has been made of the Volcker rule, the first draft that came out. What do you think is the biggest issue as it relates to Dodd-Frank for the banks at the moment?
Well, right now it is on that investment banking side and on the Volcker rule, because the challenge with reading all those pages and going through it is so much is still left to interpretation by the regulators. So depending on who the regulator is, they could go one way or the other. That's going to be a big overhang for companies like Goldman Sachs and Morgan Stanley for some time to come.
All right, Fred Cannon, Director of Research at Keefe, Bruyette Woods. Fred, thanks for your perspective. Always great to have you on the show. We look forward to doing it again.
Thanks. Great to be on.